Apple stock, ETFs, index funds, mutual funds, the list goes on, and everybody's always confused about what to get. How do I know which one's the best for me? Today, this video is going to go over exactly what to know about each one of those investment products and what you need to know to make the best decision for you. So before we break this down, I need to explain as part of the investing equation, which piece of the equation we're actually focused on today. So as you'll see on the screen, 4 layers of index investing. And really what that means is 4 layers of investment product investing. And so I'll get to that in a second. So at the very top, you see broker. Broker is where we're housing our money. Is this Vanguard? Is this Charles Schwab? Is this Fidelity? Then within that broker, we select actual accounts. These are what we talk about a lot: 401ks, IRAs, taxable brokerages, HSAs, etc. The type of actual account that you're going to invest in, which is a very important key concept. The account is not the investment, and also your broker is definitely not the investment. The investment is what we're talking about today, which is the investment product. And that can come in a lot of different ways. As you see on the screen still, you'll see that index funds are one of those investment products for this example, but those could be ETFs, mutual funds, index funds, or even a single asset. And then once we get past that step and we understand where we're at in the investing equation, now we got to go a step further to understand the asset classes available to us within those types of investment products. So as everyone knows, there's 5 major asset classes. We have cash, we have equities or stocks, we have fixed income or bonds, and we also have real estate, and we also have commodities. So the investment products we're going to speak about today, the ETFs, the mutual funds, the index funds, and single assets, will be a type of that asset class. So let's break down all 4 of these today. Number 1, we have single asset. Number 2, we have mutual funds. Number 3, we have index funds. And number 4, we have ETFs. So let's begin with number 1, which is single asset. So I have a graphic on the screen that's going to visualize this concept for you, but at its core, this is a super easy thing to buy as a single asset. So consider Apple stock, or you want to go buy gold, or you want to go buy a government bond. As an investor, if we're looking at a single asset, which is the easiest piece of this entire puzzle, we're just going to go straight to the source and buy that individual holding. For example, the Apple stock. If I want to go to Apple and actually purchase this directly, I'm going to exchange my dollars for equity or shares in their company. So then I'm an owner or part owner in Apple, and that's the beauty of investing. So therefore, we eliminate all middlemen. The middlemen will come into it as we develop into different products. But at its core, a single asset is just in itself its own thing. There'll be a lot more elements with other products that bring in a lot more complexity, and we'll get into that in a second. But we had to start with single asset because that sets the stage for the other ones. So our number 2 is mutual fund. So a mutual fund is an investment that's going to pool investors' money together to invest in the same ultimate fund itself. Let's explain. So as you see on the screen, we have 3 investors. Those 3 investors are going to put their money in a pot. Now, Mr. Finance guy over here is going to take that money and they're going to go invest in stocks and bonds or other types of asset classes we talked about earlier. However, one thing that's very common with actively managed mutual funds is there's a lot of buying and selling occurring, but not on the investor side. The cool thing is you don't have to worry about that as an investor. You put it in the hands of this professional to go do this for you. So they're going to take this money and go invest it, but because they're active, they're going to charge a very hefty expense ratio to make up for their time, to pay for the research, to pay for the resources that go into making those educated investment decisions. Now, there's a very good stat out there that says over a 20-year period, these guys lose in a big way. And a fun fact is that over a 20-year period, pretty much any 20-year period you're looking at, only about 5% of these actually beat the index, which is the S&P 500. However, a little clarity here is we'll get into index fund, but an index fund is still a mutual fund. And that is a key piece here. A mutual fund can be active or passive. So if you have an active manager, that is an actively managed mutual fund, and that is more expensive than what would be considered an index fund, which we'll get into in a second. So take, for example, VBPIX. As you can see, this is an actively managed mutual fund with Vanguard in particular, and you can even see the expense ratio hovering at 59 basis points or 0.59%. That's really expensive. It's actually not that expensive comparably to the market, which is even more concerning. This is an equity mutual fund. So you'll see all the equity holdings or all the individual companies that make up this mutual fund. Remember back to our graphic in the beginning when it showed a bunch of different companies held within this investment product. Instead of owning one full share of Apple, one full share of McDonald's, you're getting a sliver of each little guy within here based on the equity holding or equity weighting. But because this is an actively managed mutual fund and the finance guy is making active decisions, he is going to charge you more money to own this fund. And it's also why I don't love actively managed mutual funds. So that gets us into the third investment product, which is considered an index fund. So an index fund is actually a mutual fund, but a mutual fund is not always an index fund. An index fund is passive in nature, and that's a very important concept. So therefore, as you see on the screen, there's still the finance guy. However, his involvement is a lot less. So as the investors pool their money into this big pot of gold, and then that finance guy goes to invest it, typically this is something like an index or like an S&P 500 fund, or something like a sector of the market where they don't have to track, they don't have to make decisions. From time to time, there might be a little bit of overlap, but in general, they don't have to worry about all those things. Therefore, they're gonna charge you less. In fact, at Fidelity, they have zero fee funds like FZROX or FZILX, and those are totally free because the markets are competing with each other. Vanguard right now for the S&P or total market funds are around 4 basis points when I'm recording this video. However, my guess is they even reduce their fees as well. So therefore, an index fund and mutual fund are very, very similar. In fact, it could be the same thing at the end of the day. The biggest difference between the two is one is active and one is passive typically, but it's from the same family. So as you see VTSAX here on the screen, this is a good example to understand the difference in fee structure from the actively managed mutual fund to the passively managed total US stock market fund. So here you see 4 basis points is the expense ratio compared to the actively managed mutual fund, which was 59 basis points. That is extremely expensive. So if you had the exact same return from a gross basis here minus fees, here's the difference of your actual return over a 20-year period. So let's assume that you have $100,000 to start and you're investing $2,500 per month, and you do this for 20 years, assuming an 8% return. So with 4 basis points as the main expense here, you're actually going to accumulate about $1.828 million. Whereas with the actively managed mutual fund, which was 59 basis points, which was a lot more expensive, you will have $130,000 less than that other fund over that 20-year period. So those two funds, assuming they have the same exact returns, are a difference of $130,000 over a 20-year period. Now, of course, the goal of the actively managed mutual fund is to outpace the other one and on a net basis beat it. However, like I said earlier, only 5% of funds actually do that over a 20-year period. And how can you guess which one is right? Plot twist, you can't. And to have that conviction over a 20-year period with the sentiments in the markets changing, I highly doubt you're that guy. But as you can see now within VTSAX, you can see the specific sectors that this will cover in totality. So this is the total US market, which is meaning they have all 11 sectors of the market. And of course, you can have products that focus on a specific market. Index funds can be a tech sector index, or it could be a consumer staples index and focus just on purely that specific sector. And as you can see, also the holding details of all the equities within this fund, they look very similar. In fact, you probably saw a Tesla pop up a few times. Just because it's an index versus an actively managed mutual fund doesn't mean the holdings are all that different. It's just the activity that goes on within them, which gets us to our fourth investment product, which is an ETF. So ETFs are extremely similar to indexes in the fact that they're passive. However, here's the key distinction, the difference from a mutual fund or index fund, because they're the same thing ultimately, to an ETF. The ETF trades like a stock. So therefore, if I go place a trade or invest during the day, let's call it 10:30 a.m. Eastern Standard Time, that trade will occur right then and there. And with an index fund, which is also the family of the mutual fund, it will actually take place at the end of the trading day, which is 4 p.m. Eastern Standard Time. So you might ask, does that really matter? As a long-term investor, it really doesn't. We're talking timing the market at this point and within a given day, and we don't play that game anyway, and it's not gonna impact your portfolio unless it's Black Friday in 1987. So a good example of an ETF is actually VTSAX equivalent. So a lot of index funds also have an equivalent ETF, especially at Vanguard. And so as you'll see here, the ETF is slightly cheaper at 3 basis points, opposed to VTSAX, which is the exact same holdings, but a different type of investment product. So it was 1 basis point more expensive, which ultimately is nothing. And even I'll say that with extreme focus on investment fees. But as you can also see, the average expense ratio of similar funds is 79 basis points. The example I used earlier was only 59. Can you imagine how expensive these different investment products can become. And you look at the holdings here and they look extremely similar to VTSAX because they are. It's the same exact holdings, but just a different investment product that is slightly cheaper and a little more tax efficient. The main two differences with these financial products are as follows. Like we talked about earlier, mutual funds can be actively sold and traded with an intent to actually beat the market, whereas an index fund or ETF is typically going to pace the market or be the market, and that's a great thing to be. Over the last 20 years, the average investor returned about 3.6%, where the average market return, or just being the index like the S&P 500, returned about 9.6%. Pretty substantial difference. But the key difference here is the capital gains. So all the buying and selling that occurs within a mutual fund or index fund, obviously not as much for an index, but it does happen from time to time. That fancy dancy money manager running that fund and making those decisions is actually costing you more money, because by doing those decisions, those capital gains are distributed to shareholders. Now, I will pause for a second. Vanguard specifically patented in 2020 VTSAX as well as 14 other mutual funds to avoid that capital gains treatment. So there is a benefit from them. So the only cost difference between VTSAX and VTI is actually only the expense ratio and doesn't factor in those additional capital gains. However, most mutual funds do have that capital gains treatment, and therefore it's never fun to have a tax bill at the end of the year. And then the second key difference is, like we talked about earlier, is that ETFs can be bought and sold at the given point in time, whereas index funds and mutual funds are traded at the end of the day. So you might be asking, well, are ETFs the most cheap and efficient route to invest? You are actually correct. And I'll tell you exactly why I am not 100% ETF at this current moment. So some platforms do allow fractional buys of ETFs, some do not still to this day. But the other big killer for me is with index investing, I can automate and dollar cost average into my investments at Vanguard. At the current moment, Vanguard does not allow automation or dollar cost averaging for the ETFs, and therefore is the one basis point to manually do everything worth it? In my opinion, absolutely not. Now, I have called them many times and they will be coming out with a solution. Hopefully they are actively aware of this. And if you're watching this video, check the caption below because I will provide an update when that actually occurs and as of which exact date. And this video is recorded as of September 5th of 2023, just to give you some context. So to recap, as you see on the screen right now, 4 layers of index investing. We have the broker at Vanguard, Charles Schwab, Fidelity typically. Then we also have the account, which is the 401k, the IRA, the HSA, the taxable brokerage. Then today we talked about the investment products, which could be single asset, mutual fund, index fund, or ETF. You have to select as an investor which products make sense for you. It doesn't have to be all of the other. It could be a mix of a few of these. But now you have more education on what each of these products actually means and how this actually impacts you as an investor. And I hope this is extremely clear for you going forward. And if you have any additional questions about the broker level, the account level, or the investment product level, I'm going to put in the show notes below the associated video for each one of those so that you have access to every single one so that you can understand the full picture by watching all 4 of these videos together. And I want to make your investing life super simple because this stuff at its core is pretty simple, and I will see you next Monday.